Good evening, ladies and gentlemen. Myself, Daniel, representing PMS Bazaar. I welcome you all for the insightful session on dynamic asset allocation, the smarter way to navigate market volatility. On behalf of the participants, I welcome Mr. Siddharth Vora from Prabhudas Lilladher. Before we proceed, let me give a quick introduction about Siddharth. Siddharth is the head of Quantitative Investment Strategy and Fund Manager at Prabhudas Lilladher. He was instrumental in developing Prabhudas Lilladher quantitative proprietary module by conceptualizing and spearheading multi-asset dynamic portfolios, which is a nimble and broadly diversified portfolio which has over 2.5 decades of history worldwide, and it's catching up in India in a big way, which has more than 12.5 trillion USD in assets under management. Siddharth is a CA and CFA Charter holder, as well as M.Sc in Management of Business Excellence, with studies at world-renowned universities such as Harvard and London School of Economics. So now it will be more like sort of a Q&A session. And before we proceed, I request Siddharth to give a brief introduction about this multi-asset dynamic portfolios, and then probably we'll start with sort of questions which will be benefiting the participants.
Great. So firstly, welcome to everybody who's taken our time to attend this session. And thank you so much, Daniel and the PMS Bazaar team, for giving us this opportunity to help investors protect their capital in these tough times and navigate market volatility with a lot of ease. So I'm going to talk a little bit about the whole concept of dynamic asset allocation and why that is the smartest way to navigate volatility on the upside and on the downside. But before I get there, a little bit about Prabhudas Lilladher, the company that we belong to. So we have been in the capital markets business since 1944, and with nearly 8 decades of experience and wisdom that we bring to the table, we wish that all investors can benefit from our diverse teams, our leading research DNA, and the trust that we've brought in the industry for the last so many years. And now I think it's time we can start the Q&A and talk about how asset allocation is relevant in today's times, even more than it has been in the last decade. Over to you, Daniel. So,
yeah, see, in the testing time like this, so how do you manage the multiple risk and control portfolio volatility through your portfolio strategies?
Sure. So firstly, let us understand what the risks are and where the risks come from. So risks are usually external in terms of macro, monetary, inflation, geopolitical, but the volatility is internal to the portfolio. So our job as fund managers is to manage these risks and control the volatility. If we have a look at what's happened, year to date in the world across asset classes, it seems extremely evident that whether it is bonds, government bonds, corporate bonds, equity indices around the world, it's been an extremely hard year. All the assets have given up a lot of the returns made in the last 2 years. And there is a very clear trend that equity indices and risk on assets are out of favor today. We also need to understand why this is happening and how this can be managed. So I think a couple of points here. Firstly, because of COVID, the Fed balance sheet had expanded almost to $9 trillion, which has been a historic high. And managing that kind of debt, it's extremely difficult. And to manage it, what we've started now is come from a quantitative easing cycle, then gone on to tapering, and now we are actually on the cusp of tightening. And tightening is, we are just starting this cycle. And when we go into a rate hike cycle, many spillover impacts can be clearly visible. For example, borrowing becomes more expensive. Inflation that is already at highs is compressing corporate earnings. And a combination of this can be seen in contracting PE multiples, because as your discounting cost or your discounting factor goes up, the first impact is on PE multiples. And this is a double whammy because inflation is hitting margins and therefore compressing earnings. Combined with that, we are seeing rate hikes, which is also going to hit multiples. So it is a dicey situation on managing pure equities. And therefore, we believe asset allocation could really help in such a period. If we look at some of the emerging themes globally, and this is what the data is telling us, that till 2021, the concern was around inflation and reflation. As we stand in 2022, the talk is more about stagflation. Stagflation is basically a combination of slowing economic growth and rising inflation. And this is an extremely rare phenomenon. And it's happened only a couple of times in history so far. If we look at what the data suggests, all the large countries and economies are actually dealing with inflation numbers way higher than their central bank targets. So this is challenging. Other than that, if we see how the IMF is projecting the world to move ahead, across the board, emerging economies or advanced, like developed economies, they've slashed down GDP forecasts. So therefore, growth is a concern. And at the same time, they've increased their inflation forecasts. So if we see for 23, inflation forecasts have been revised from 4.8% to 6.5% for emerging economies. Similarly, GDP forecast has been cut from, say, 4.7 to 4.4 for 23 and 4.8 to 3.8 for 22. So this is a difficult macro and monetary combination that we are facing. And another factor that we need to understand in terms of the risks building up in the system is also valuation. Given the flux of liquidity that we saw post-COVID, a lot of growth stocks and momentum stocks did really, really well. And overall, risk on assets performed very well. Over the last 6 months, what we've started noticing is that valuations and value as a factor in investing has started becoming relevant all again. And therefore, we must be able to decipher not just how the macro and monetary regimes are evolving, but also how to be conscious on the valuation front. We cannot be paying too much for an asset whose earnings might compress or the discounting rate might go up. Therefore, the multiples we give to those earnings might collapse. And even when we look at Indian markets, we see that crude has negative bearing on how GDP growth numbers, inflation, and current account deficits are impacted. So what we've collected here is that every 10% rise in oil prices shaves off 0.2% of GDP, distorts the current account balance by 0.3%, and increases inflation by 40 basis points. So as of now, we are in a crude rise environment, and we need to be aware of these risks also. Other than that, weak INR will cause higher imported input costs and higher imported inflation. Therefore, it will put more pressure on companies and businesses that are dependent on imported raw materials or commodities for that matter. And the last thing we need to also see is that commodity inflation is at historic highs right now. And as of now, there are no trends of this reversing. This is probably a combination of the geopolitical tension in Russia and Ukraine. At the same time, the lockdowns in China also have some impact. So at this point of time, it is very important to understand how to really move ahead through these cycles and what is the right mix of assets that help us navigate. So here I've put a very short snapshot of how we move asset class and risk based on the different cycles we are in. So right now, we're looking at monetary tightening in the short term where interest rates are going up. And therefore, a clear focus must be on inflation proofing. If it's an equity investor, inflation proofing becomes very important. From an asset allocation perspective, overnight money market funds and short duration debt instruments become very relevant in the portfolio. We have come from a cyclical growth and recovery phase, basically. So right now we are here and probably also between these two zones. And therefore, the asset mix should be tilted towards inflation proofing, monetary market, money market funds, and government bonds and gold. And we are coming from here, which is commodities, cyclical stocks, risk on assets, and growth companies. So it's very important to understand that the dynamics and the paradigm has shifted for the visible future, and therefore the portfolios must also reflect this shift. So now coming to how we really do it. So this is a snapshot from 2007 till 2022, how all the different asset classes have performed and how does an asset allocation approach, whether conservative, aggressive, moderate, or dynamic, which is our fund, how do they perform in these cycles? So basically, if we look at aggressive, moderate, and conservative, across all the years, we've been in the median and above median category, never too low, never too high. But the whole point of multi-asset dynamic is consistency, stability, and peaceful sleep at night. So you don't have to worry about what's happening in the markets. Your capital beyond a point will be protected. And we generate alpha with capital arbitrage here. So every time there's a huge drawdown in the markets and our portfolios are not in risk assets, we basically have double the capital to deploy at those lower levels. And that is what helps us generate alpha over different cycles. Up to you.
So start in terms of dynamic asset allocation, so how actually it's helping you to generate alpha in a falling market as well as in the rising?
So as I just touched upon, so alpha is generated via the concept of capital arbitrage. So in bad markets, we tend to erode less and we protect capital to a greater extent than a single asset approach. We have more capital to deploy at lower levels to ride up the cycles and therefore generate higher alpha across market cycles. And because this is dynamic in nature and there's an element of tactical changes in the asset allocation, we believe that riding cycles and being agile is very important. You cannot have a very static approach here. And I think the biggest source of alpha is eliminating sector risks, eliminating style risks, and eliminating stock selection risk. Focusing purely on asset allocation, because we believe 90-95% of returns are actually contributed by the asset allocation decision itself. And therefore, being in the right asset at the right time with the right exposure helps us navigate cycles better. Obviously, we also don't get it all right, but over a long period of time, our attempt is to get most of it right. And I believe our historic tests and live performance do suggest that we are fairly on the right track as of now. And just to illustrate on the point of eliminating risks, that is an extremely important part of managing volatility at the portfolio level. What we've done here is we've identified the different sources of risk that could be built into a portfolio. For example, stock, sector selection, and style selection risk. So firstly, these are eliminated by going into passive instruments. And if we look at the data, I think this is the last 3 months, Nifty 500 has fallen 7.5% in the last 3 months, which is like the broad equity index of India. It's 2.7 times more than how much MADP has fallen in the similar period. Another important statistic to understand is 69% of Nifty 500 stocks have fallen more than twice the fall in MADP in the last 3 months. And 49% of Nifty 500 stocks, which is almost half of the Nifty 500 stocks, have eroded 4 times the wealth of MADP. So the idea is by sticking to a passive and dynamic asset allocation approach, we are able to control these market falls to a huge extent. Other than that, the next risk we talk about is sector selection. So here we've just populated all the different sectoral indices and how they have performed. So if you look at 3 months, MADP is down, say, 2.8%, but 2.8% is much better than all the other indexes which have fallen between 10 to 15%. So the idea is to systematically eliminate each of these risks and therefore protect capital. And the last risk that we try to avoid is a pure play asset selection risk. What I mean by that is when I'm extremely heavily concentrated on a single asset class, my returns tend to be volatile in the short to medium term and therefore also reduce long-term CAGRs by that extent. A multi-asset approach, on the other hand, helps you reach that same destination of superior consistent returns, but the journey is extremely smooth. That's the real point here. So again, if we look at 3 months data, we're down, say, 2.8%. But most of the other asset classes are down much higher, including gilt. Can you imagine? Gilt is down 1.8% because of the rate hike cycle that we've entered. Corporate bonds are down, NASDAQ is down, all the asset classes are down right now. But the idea is, by shifting the mix, we try to ride this volatility through. Over to you, Daniel.
Yeah. See, over the long term, do you think passive fund management can outperform active fund management, Siddharth?
Yes, I do believe so, and I'll show that with data. So this is a snapshot basically, where we've seen that even in India, so as on the Western markets, this trend is widely popular, where passive funds are outperforming active funds and also gaining the lion's share in terms of AUM. So if we look at the data here, there has been a very, very clear and evident shift in terms of investor preference from active to passive. In 1998, the passive mix of total AUM in the US was, say, at 11%. Moved to 2019, we are already at 50% in terms of passive. And the early data that we're getting for 2022 shows that we are north of 69% in terms of passive mix of the total AUM. So this is what the Western economies and the developed markets are showing us. And this is partly because of lower cost of passive. At the same time, Western markets are way more efficient. So as the markets keep becoming more efficient and the information arbitrage reduces, what we tend to see is that generating alpha becomes harder. Over the last 5 years, we have also seen this trend starting in India. If you see the spree of the new passive funds that are being launched by all the AMCs, you will understand how things are changing on ground. And in terms of performance numbers, what we've noticed here is that roughly 80-85% of actively managed funds are not able to beat the passive benchmarks itself. When the performance is not there, why would you justify a higher cost, right? So passive instruments gives you the ability to reduce your cost, at the same time eliminate style bias, sector bias, and stock selection bias. And we believe over the next few decades, passive is going to become extremely massive in India, like it has in Western economies.
Okay. So what are the proprietary quant methods used by you to manage the asset allocation in such dynamic and uncertain times like this?
Okay. So this is basically the secret sauce and the entire architecture which is used to navigate asset allocation, and it's basically the core of the product. And if investors understand how this model works, what are the constituents that drive asset allocation, the conviction to go for an asset allocation strategy goes up 10x. So I'll start with explaining the way we look at equity investments, right? So whenever we are evaluating a stock, we look at a couple of simple parameters, whether it's the quality of the business, the management, the balance sheet strength and quality, cash flows, growth, and valuations. These are broadly some of the common factors we look at across quality, growth, and valuation. Even when we are doing asset allocation, the concept remains the same, that we need to understand what drives asset classes, what drives cycles of these asset classes, and what factors help us identify inflection points in these asset classes. So we've tried to decode this whole piece. And the first factor which we believe is extremely important on a long cycle basis is economy itself. So we have a proprietary tool called the Macrometer, which focuses purely on understanding economic cycles and where we are in part of the economic cycle. Are we in a strong growth regime? Are we in a steady growth regime? Are we in deceleration, recovery, or slowdown? And the Macrometer understands not just the domestic economic cycle, but also the global economic cycle, and therefore gives us a strong perspective on how asset allocation should be done, keeping the economic cycle in mind. The next factor, which is extremely important, is the monetary cycle, because monetary cycle gives us a view on the interest rate regime, the liquidity, and the broad money supply in financial markets. And as we all know from experience and data, that liquidity and interest rate regimes have a significant impact on the performance of the different asset classes. So obviously, falling interest rates, higher liquidity is beneficial for risk-on assets, and rising interest rates, lower liquidity is detrimental for risk-off assets. But even when we look at fixed income instruments, the monetary regime has severe implications. Whether government bonds, which are extremely long duration, corporate bonds, which are short duration, and overnight funds, which are extremely short duration. So which part of the regime we are in and how to navigate even the fixed income allocation is extremely important. For example, right now, we are overweight on short duration and completely out of long duration bonds. So we are more tilted towards liquid and corporate bonds rather than gilt funds. So that is the implication in terms of asset allocation. Similarly, the third factor and the third tool that we use is the cyclometer, which helps us gauge equity market cycles. And as we all know, we have come from a highly overvalued market cycle into a overvalued or fairly valued kind of zone as of now. But we believe the way markets and economies are evolving, the valuations are still not comfortable. And therefore, we are cautious. Now, the way this model works is we have three different long cycle indicators, which is the macrometer, the monetary meter, and the cyclometer, and 6 different short cycle indicators, which help us capture momentum, technical risk reward, sentiment, relative valuation, and global risk appetite. So the whole bucket, when it comes together, it tries to identify the different risks and opportunities in the system, and therefore gives us asset allocation as the final output. Now, the way the model works is we do not use either of these indicators in isolation. All of them are used in a combination. And therefore, if the economy is strong, but the momentum in equities is waning, or the technical risk reward is not favorable, or the sentiment is weakening, then the asset allocation gets adjusted accordingly. So we dynamically monitor the model on a daily basis, and we tend to rebalance only if we get a regime change signal. So we do not rebalance our portfolios on a day-to-day basis. Every time a significant material regime change is captured, that is when we go about rebalancing the portfolio.
Fine. So what's your model indicating right now, Siddharth, based on your different quant meters used? And can that help to navigate the periods like this? Does this quant meters had given any sort of indication about the recent correction in the market?
Okay, so I'll come to that. So I've put a snapshot of all the readings, the critical readings of the meters between June 21 to May 22. So what we've seen is that the economy has gone from deceleration to steady growth and now to slowdown. So that's an indicator of weakness. The monetary cycle has gone from expansionary to contractionary, again a sign of weakness. The cyclometer, if you see the third one, it was overvalued, then reached highly overvalued zone, which our model captures as a peak formation zone. And peak formation doesn't mean that on the day it captures, next day it forms a peak. It doesn't work like that. It's a zone. So if you see between, say, October, November, December, Jan, we've been in that zone. And our models have been telling us to be light on equity and keep trimming exposure at higher levels. And now we have gradually moved to a fairly valued zone, but the trend is still deceleration. So when we are in fairly valued and the trend captures acceleration, that is when we can gradually move our equity exposures up. So I believe the first 2 indicators itself have kept us very cautious on our equity exposures. Even the momentum has been continuously telling us since December to move out of equities. So invest in FI refers to invest in fixed income. Then it's gradually moved to invest in gold. It had triggered a temporary invest in NASDAQ, but that fizzled out and moved back to invest in gold. So this is how the momentum tool also helps us capture where to position our asset allocation. Technometer has also been telling us mixed signals, but as of now, since Feb, it's been a sell, buy for mid caps, buy in April again, and then sell in May. So the idea is not to look at any of these indicators on an isolated basis. We have our base indicators, which is macro, monetary, and cyclo, and then they are supported with momentum, relative value, risk off, and technometers. So these tools actually help us navigate this difficult period with fair amount of ease, I would say. And I'll also take you how our asset allocation has moved. So say in January, say we were 65% portfolio in equities, 18% in debt, 11% in gold, and say 4% in liquid. This mix over the time has actually changed to 42% equities, 29% debt, 15% gold, and 12.5% liquid. So this is basically showing you how over the times the asset allocation has changed and how dynamic the model has been in terms of rebalancing. To give you two particular examples, in January itself, we had sharply increased our gold allocation from 8% to 20% almost. And 45-50 days ago, when the markets had gone across the 18,000 level, because the HDFC twins had the merger event and the markets were pulled up because of that, our sentiment tool captured that because the index move is driven by only a very few stocks, the polarization is high, the breadth is low, and the move is unsustainable given we are already in a highly overvalued zone. So that was the day it triggered us to trim almost 10% of equities. So north of 18,000, we trimmed almost 10% of equities. And since then, we've been extremely comfortable on our equity allocation. And we are way below our benchmark, which is still at 50%. We are at like 40-42% in terms of our equity allocations. Over to you, Dan.
So, Siddharth, when your indicator gives probably a weakness for equity allocation or equity market, so will you hold the position or will you exit completely from the equity side, or you will gradually reduce the position?
So we don't take sharp decisions in terms of trimming portfolio from 80% to 10% or 15% overnight. That's not how it works. It works in a staggered manner. And I don't think our model is built in a way that overnight, we sharply reduce or increase exposures. So I think we stagger it in 10% kind of moves.
Then with the rising crude prices and commodity inflation across the board, so how is your portfolio insulated from this, Siddharth?
Okay. So there are a couple of things here. So firstly, allocation to gold in a rising crude, inflation, and commodity environment acts as a significant inflation hedge. Also, when interest rates are rising, minimal allocation to long duration gilt funds is extremely critical. Over the last 8 months, our allocation to long duration bonds have been at 2.5% versus short duration north of 10, 15, 20% also. So the idea here is staying put in gold, not being exposed to long duration funds, and higher allocation to short duration debt securities, liquid, and cash instruments. And till the data doesn't suggest any change in macro regimes, we are also going to be underweight on equities itself. So given that we are dealing with inflation, economic slowdown, rising interest rates, I think an underweight on equities, overweight on short duration is how our strategy is dealing with rising crude, commodity, inflation, etc. And the important thing also is that this is a very peculiar scenario where equities and long duration bonds both show positive correlation. So they start falling together. So it is not possible to really, avoid any downside. The best that a multi-asset approach can do is significantly curb your downside. So if your equity portfolio is say down 20-25%, we could probably stop at 5-10%. And that is the differential we can create in a bad cycle like this.
So with a sharp erosion seen in the Nasdaq, will Nifty also mimic the correction? What's the impact can international exposure have on your portfolio, Siddharth?
Okay. So firstly, I would say that it's not really right to compare Nasdaq and Nifty, given the constituents are different. Nasdaq is long duration, future growth tech companies, and in a rising interest rate environment, valuations of all these long duration asset classes will contract, be it equities or debt. On the other hand, Nifty 50 is a well diversified index and not focused on tech companies also. Even if you see the broader valuation, cash flow, and growth visibility profile of the Nifty index, I think it is much more stable than Nasdaq. We can, however, compare S&P 500 to Nifty to a certain extent. Because if you look at the data, S&P 500 is down about 17-18% from the recent highs, and Nifty is down also 15% from the recent highs. In the exact same period, Nasdaq is down more like 28-30%. So comparing Nasdaq to Nifty is not really an apples to apples comparison. And global markets are co-related but not co-integrated. And that means that if a certain market falls by X%, it is not necessary that Nifty also falls or Indian markets also fall by the same percent. The problem of inflation, I would say, is much more serious in the US than in India. And economic outlook for India over the next 3 to 5 years, I think it is the best compared to most of the other emerging markets and developed markets. So it is not necessary that domestic equity indices might fall in line with global indices in the current cycle that we are in. And given that our allocation to Nasdaq is very meager, so we were 8% in say 2021, we're down to 4.5% as of now. So I think we are fairly covered given the currency tailwinds by strengthening dollar that the Nasdaq ETF also provides. So what we need to understand is the rupee denominated Nasdaq index, which we invest in, versus the dollar denominated Nasdaq index, which is the global representative. So we still have some currency tailwinds here, and we might be better off than the pure play Nasdaq. So overall, with a very, very small allocation, say 4-5% to Nasdaq, I think the overall portfolio is fairly insulated.
Right, Siddharth. So now we have a couple of questions from the participants. So probably, I'll read out, so probably you can address their queries. So Navneeta Ashmira has asked, like, how exactly does a dynamic asset allocation work? If you could give a numeric example, that will help.
Okay.
So if you could give some numerical example, for example, he say having 100 rupees. So how that a dynamic asset allocation will work? So that's what his question is.
Sure. So this is how the asset allocation works. Very clearly, I'm going to be able to explain it. So there are two components to the portfolio. There is a fixed component and there is a tactical component. The fixed component includes all these asset classes such as, the Nifty 50, the Nifty Junior, the mid cap, US equity, gold, corporate bonds, gilt, and liquid in a certain predefined ratio as per our model. The fixed component is a long-term in nature, and that changes only once in a year if our model captures a huge regime change. So the fixed component is your long-term capital tax component, and the tactical component, which is the other 50%, is dynamic in nature. And the dynamic component has two parts to it, the core and the satellite. The core is driven by long-term indicators such as cyclometer, macrometer, and a couple of short-term indicators such as momentum and technometer. Other than that, there is a 30% satellite allocation within the tactical component, right? And the tactical satellite is driven purely by sentiment, and therefore we could be able to manage 15% of your total portfolio absolutely based on tactical cues that we get from our models. And therefore, you have one part of your portfolio which is stable, long-term, and diversified, and the other part of your portfolio which is dynamically adjusted to capture the broader changes in the macro, monetary, and valuation regimes. To give an example of how asset allocation moves through the live portfolio, I think this represents since Jan 2006 till now, till 2022, how the asset allocation has changed across cycles and across periods. So the blue here represents Nifty, the dark yellow represents junior, this one represents mid caps, S&P 500, NASDAQ, gold, corporate bonds, gilt, and liquid. So over the cycles, we see that our model is able to dynamically move in and out of asset classes for the tactical component of the portfolio. And the idea to do this is only control risk and have more capital when outlook is favorable. That is the simple way the strategy works.
Yeah, and we have received the same question from Indranil as well as Jayan. So they were asking, like, once the weightage of allocation of a particular asset class has been finalized, how do you shortlist these stocks within the asset class? So do you have any parameters or anything to be...
Okay. So as I said, we do not invest in stocks. We do not invest in sectors. We do not invest in any direct equity instrument. The only investment is made via passive instruments. And the passive instruments in our portfolio include the Nifty 50 index fund or ETF, the Nifty Junior index fund or ETF, the mid cap 150 index fund or ETF, the S&P 500, NASDAQ ETF, gold, gilt fund, corporate bond via Bharat bond, and liquid funds. So the only call we need to take is on allocating your capital across these asset classes via index funds and ETFs alone. And there is no stock, sector, anything in this portfolio.
Okay. So what are the returns that one can look at 5-year view and 10-year view if they are opting for this dynamic asset allocation portfolio?
Okay, so what can happen, I will get to that in a moment, but first let's look at what has happened. So if we look at 3-year and 5-year regimes, let's look at 5 years to start with. So the best 5-year CAGR for a strategy like MADP has been 23.6% net of expenses, fees, impact, cost, everything. The worst 5-year CAGR has been 7.6%. The median has been 13.7% and the average has been in the range of 15%. The standard deviation is at 8.4%, which is significantly lower, almost half of most of the risk-on asset classes that we see. Now, what is really important to understand is that when we are going through the worst 5-year cycle at 7.6%, Nifty returns for that same 5-year cycle is minus 0.9%. Mid cap for that same 5-year cycle is minus 1.6%. Small cap for that same 5-year cycle is minus 7.4%. So in challenging cycles also, a dynamic asset allocation approach has been able to give us a 5-year CAGR of 7.6%. Now, if we look at a shorter cycle, which is 3 years, the worst has been 6.6% CAGR, best has been 31.9% CAGR, median and average is in the 14 to 16% range. But again, I focus my conclusion on the worst returns. Because when we are delivering, say, 6.6 as our lowest return, what has the other asset classes delivered? So gold is negative 8.2, Nifty is negative 1.5, junior base is negative 3.8, mid cap is negative 9.5, small cap is negative 16% on a 3-year CAGR basis. So, and S&P 500 is also negative 7.9. So what is important to understand is that 6.6 is a low number. But we are delivering 6.6 when all the other asset classes are delivering much more inferior number and even going to put investors through capital erosion. And that is the important point to understand. Now coming to our outlook from here on, I think genuinely this is the most appropriate time for an asset allocation approach with all the macro monetary developments paving way for a much tougher market than we've seen in the last 24 months. To navigate this uncertainty, I believe a dynamic asset allocation would definitely outperform the broader equity and debt indexes also, given that we are not taking a pure play risk on a single asset class. The developments that are happening around the world, whether geopolitical, monetary, or macro, they are so fast and dynamic that managing volatility and drawdowns is 100% more important than actually trying to generate returns. So every time you have to mentally position yourself that do I want to generate very high returns or do I want to be conservative? And market cycles over the long term give you both opportunities, but you have to be cautious and wise to know this is my time to protect money, this is my time to grow money. And right now, the way the data is telling us, it is the time to be cautious, to protect money, and make sure when things improve, we have enough capital to redeploy for growth. Another thing I would say is investors must tone down their return expectation in times like these. And I say this right now because everybody is used to the 2 year of speedy high returns that we've seen, and that might not continue in the visible future. And therefore, the focus must shift from capital growth alone to wealth preservation in a disciplined manner. And I think that will do justice to the risks that we face today.
Okay. So that one more question from the participants, like does MADP follow any upper cap limit for sectors like index and asset class like gold, etc.?
Yes, so we do have caps on all the different asset classes. To give you a broader idea, we do not exceed 80% in equities at a total portfolio level at any given point of time. The capping on sector is not really relevant because we don't take sector exposures at all. We only take asset class exposures. And the lowest equity will be in the range of 30%. The highest will be in the range of 80%. The minimum non-equity exposure will be in the range of 20% of the total portfolio. And in between these ranges, allocations keep evolving. I don't have that data on this slide yet, but I can probably get that sent to PMS Bazaar, and PMS Bazaar can send it ahead to the clients who have this requirement.
So, and one participant has asked, like, what indicators exactly do you use in a techno and momentum meter?
So in technicals, we have more like 8 different technical indicators, which are a combination of MACD, RSI, Hull, Super Trend, and those are some of the indicators we use. But it's not just what indicators we are using. The challenging part is how we are using these indicators. So identifying that, okay, I want to invest in high quality stocks, that is easy, right? But how to find high quality, that is the challenge. So it's more about how we use some of these technical indicators, what kind of weights we give them, how we use them as signals, etc. And in momentum, we follow a dual momentum strategy. Dual momentum focuses on absolute momentum in all the asset classes and relative momentum across all the asset classes. And therefore, on a rolling 1 month, 3 month, 6 month, 1 year basis, we want to gauge whether the trend is changing at a particular asset class level or amongst these asset classes. So in January, our momentum meter was the first to indicate that the trend is shifting gradually from equities to gold, and therefore we were able to increase allocations from 8% to 21% to gold. I hope that answers both the questions on momentum and technicals.
Yeah. So, and finally, most of the participants, they were very keen to know about your no fee structure, what is the exit clause and other stuff. So,
okay. So there are 2 fee structures. The one we do recommend to all the clients is a fixed fee of 1.25%, 0 entry load, 0 exit load, no lock-in periods. 1.25% is your management fee or your fixed fee, and 15% profit share above the 10% hurdle rate. So 10% hurdle, 15% profit, 1.25% fixed fee. This is the hybrid model. and a few investors over a long cycle have also preferred a fixed fee model. I believe the fixed fees are at 2%, and there is no profit share component in this.
Fine. So basically, you will use the higher watermark level when you take the hurdle rate.
Absolutely. The higher watermark is applicable.
Fine. 1 second. So, and one more question has come now. So it will take, this is the last question. So he's asking like, so when you are in your presentation, you are saying that you are investing in short tenure bonds, right? So you have invested about 25% in Edelweiss Bharat bond ET1. Does this contain only short duration bonds?
So these are corporate bonds, which are short duration as compared to government bonds, which are 10-year bonds. These are rolling 3-year bonds. So they have the ability to revise with the movement in the interest rate cycle, which a government bond does not have. And even if you evaluate the performance of the 3 different durations, which is long, short, and ultra short, it's very evident that long duration bonds are penalized more heavily, short duration bonds a little less, and ultra short duration bonds are not been penalized at all. And the other reason is when we are parking funds in short duration bonds, if you hold them to maturity, you anyways get the yield to maturity and the whole capital back. So it is tax efficient on a 3-year basis anyways.
And some of the very basic questions, like I myself addressed that. So it is a PMS product, not AF product, and the minimum investment for this PMS scheme is for 50 lakhs. So any PMS, the minimum investment is 50 lakhs. So dear participants, if you have any other questions, you can write to us at events@pmsbazaar.com. So we'll try to collate all the questions and we'll get the answers from Siddharth Vora and we'll send across to you. So with that note, we will conclude this webinar. Dear participants, once again, thank you for joining us for this insightful session, and thank you, Siddharth, for sharing your knowledge. And I hope that all the participants would have gained or understand about the dynamic asset allocation, the way that Prabhudas Lilladher is managing clients' money. And wishing you happy and safe weekend. Thank you, everyone.
Thank you.